Hello everyone, welcome to Just Invest Today, and in today's video we are talking about Lou Simpson, an amazing value investor. He actually averaged 20% a year compared to the S&P that averaged around 13% a year from 1979 to 2004. And this was under the Geico auto insurer. He was a chief investment officer there. And remember, Geico was owned by Warren Buffett, and Warren Buffett himself called him one of the investment greats. So Warren Buffett gave him high praise. He wanted him to stay there as long as he can, and he was an investment officer for 3 decades. So with that amazing track record, we have to actually look into what he did, advice that he gave, and kind of his investment strategy. It's super important to learn from the best investors. And remember, he actually beat Warren Buffett's record. Warren Buffett admits that he was killing him. At the same time, Warren Buffett had a lot more assets under management, so Lou Simpson was able to invest in smaller companies that Warren Buffett couldn't. That was a huge advantage for Lou Simpson, but otherwise, Lou Simpson was still an amazing investor. Lou Simpson actually passed away at 85 years old this year, so I thought this would be a good video just to go over everything he's done for Geico and his investment success. So Lou Simpson actually gave 9 strategies and advice on how to become a better investor. So let's go through them one by one. Can you please like this video, subscribe to my channel. I'm always providing you guys with so much new content, man. So subscribe. Before we go into number 1, we gotta look at Lou Simpson's actual investment strategy. So before he actually got into Geico, Lou Simpson was actually really focused on high growth companies, and he was trying to buy them at a bargain price, but he really didn't know what the bargain was. And it was hard to actually predict where they were gonna go. That's how he had a lot of ups and downs in his strategy. He was looking for companies that were gonna perform amazing, and he would have a lot of ups and downs in that strategy. So he actually decided to kind of switch his strategy over buying companies that actually have a long history of overperformance at bargain prices with low risk. That's what he actually changed his strategy to, because buying companies promising future riches wasn't the way to go for him. He wanted these high performing companies with a nice history of overperformance, a good track record, at a low price, at low risk. So Lou Simpson actually had the same strategy investment philosophy as Phil Fisher and Warren Buffett. Concentrated bets at reasonable valuations with great management. Now let's get into the first strategy that will help you make these 20% annual gains. Number 1, buying quality businesses. Investors should actually identify buying quality businesses below intrinsic value. That's the essence of his investment philosophy. We want to look for the difference between the market value and actually the intrinsic value, and look for that opportunity to buy when there's a huge difference between the two. Do your own analysis. As an investor, you should be able to actually do your own research and actually find out what the company is actually worth and do your own analysis on that. What comes with that is that you're going to get a lot of irrational people telling you what to do. You're going to get a lot of emotions in the market, and that can also hinder your investment decision. So make sure you're doing your own work. You also have to be a contrarian. You have to be able to actually detach yourself from the market noise. Think about it. You have to be able to love unpopular companies and actually look for unpopular companies to invest in, because usually they present the best investment opportunities. Try to be skeptical of conventional wisdom and try to avoid the waves of irrational behavior and emotion that periodically engulfs Wall Street. We don't ignore unpopular companies. Number 3, invest in high return businesses. Lou Simpson actually believes that if you invest in these high return businesses, over time, the stock appreciation is actually going to follow that high return business. So if it's averaging a high return on invested capital, on equity, the business usually is going to follow that with growth of its earnings. So make sure you invest in these high quality companies that can actually sustain that ROE and sustain the earnings growth. Number 4, pay a reasonable price for an excellent business. So no matter how strong the company is or how superior the business is, it's not worth an infinite price. So you got to make sure that you're paying a reasonable price for the actual growth in that company, because when you overpay for a company, your returns on that company might not be that great. So you got to make sure you're paying a reasonable price for the growth of the company or the growth of that business. Number 5, invest for the long term. Trying to predict the ups and downs of the market or your stock or the economy is not going to help. You got to make sure you're investing in sustainable, long, durable businesses to get these investment results. Number 6, do not over diversify. When you over diversify your holdings, Lou Simpson thinks that you're just going to get average results, not superior results. Your ability to find good, strong companies and make large investments in them is what's going to guarantee you your superior results over the average of the market. So that's what you're going to have to do if you want superior results over the S&P 500. Make sure you have concentrated bets in superior companies. Top 5 Geico holdings accounted for 50% of the stock portfolio at Geico. So that shows you how concentrated he actually was in his bets. Read as much as possible. Lou Simpson thinks that you should be reading newspapers, annual reports, industry reports. He said that you should be reading 5 to 8 hours a day. That's how much reading you should be doing if you want to become a successful investor. Number 8, make wise decisions. The more decisions you end up making, you actually have a higher chance of actually being wrong. Investors make the mistake of selling their winners and keeping their losers, hoping the losers will come back even. Instead, he says, sell the things that didn't work out and let the things that are working out run. One thing a lot of investors do is they cut their flowers and water their weeds. Generally, it's more effective to cut your weeds and water your flowers. If I've made one mistake in the course of managing investments, it's selling really good companies too soon. If you've made good investments, they will last for a long time. Number 9, be patient. A lot of investors do not have the patience or the temperament to be actually successful investors. The stock market is like the weather, and if investors don't like the current conditions, all they have to do is wait for a while for things to get better. If you cannot be patient, it's impossible to be successful. While being patient is the key attribute, you must also be capable of being aggressive and pouncing on opportunity when the time is right. Patience and aggressiveness are desirable qualities for an investor. May seem a bit odd to some people, but they are essential. Hence, according to one of the greatest investors of our time, dealing in our circle of competence, dealing with companies that investors have the ability to understand, being able to come up with good analysis of a company's value, and earning power are fundamental for achieving success as a value investor. So that's it for the video, guys. Those are 9 strategies and tips from Lou Simpson, how to become a great investor and beat the market. So please like this video, subscribe to my channel, and I'll get back to you in the next video.